Everyone's talking about those 50-year mortgages right now, and it looks like it might actually happen. Some say it's the big fix that'll make homes finally affordable again, and then others say it's just simply a financial disaster waiting to happen. But will it actually help the housing market or just make things worse? Well, in this video, I'm going to break down what a 50-year mortgage really means for your wallet, your equity, and your long-term goals. So stick around, because by the end, I'll share with you one realistic change, and I'm not talking about interest rates, that could actually unlock the housing market overnight and get people buying and selling again. So yes, this isn't just a rumor. A few days ago, the president mentioned the idea publicly, and Bill Pulte, who oversees the Federal Finance Agency, replied that they're actually working on it. And you might know that name, Pulte, as he's the grandson of the founder of Pulte Homes. They have a lot of subdivisions around our area, along with other branches like Centex Homes, Del Webb, and DeVosta. Those are all under Pulte. But anyway, now all of this sets off a firestorm. Agents, lenders, buyers all weighing in. Some saying, finally, this will help buyers afford more properties. And then others said this is going to be a nightmare. So like most things in real estate, both sides have a little bit of truth. Now here's the idea. By stretching your mortgage term from 30 years to 50, your monthly payments, they're going to drop, but maybe just a few $100s. But it comes at a big cost because you pay tens of thousands more in interest over time. And because banks are taking on longer risks, they'll probably charge a little higher rate anyway. So the savings isn't as big as people think. And most experts estimate that it will only let you afford maybe 10% more house. So in a market like Sarasota, that might bump you up from a $450,000 home up to $495,000. But at the cost of 20 years extra payments and far more interest. Let's talk about the biggest misconception that I keep hearing, that longer loans build more equity over time. And that's not how it works. Equity doesn't come from paying, it comes from holding. And here's what most buyers don't realize. In the first 5 to 10 years of your 30-year mortgage, almost your entire payment goes towards interest. Now on, say, a $2,000 monthly payment, at the beginning, maybe you pay $100 to $120 a month actually towards that loan balance, but it takes roughly 20 years before your payment becomes 50% interest and 50% principal. That's why lenders love when people refinance. It resets that clock, so you're front-loaded again with interest. So yes, a 50-year mortgage might make your monthly bill a little lower, but you're not building wealth any faster. You're just paying the bank more for longer. And in Sarasota, where the average homeowner moves, say, every 7 to 10 years, whether upgrading, downsizing, or relocating, no one's staying long enough to pay down that 50-year loan. Heck, nationally, the average age of a first-time home buyer hit our all-time record high, 40 years, 40-year-olds. So you might not outlive your loan. Now, is there any other good that comes out of a 50-year mortgage, other than, of course, the reduced monthly payments? Well, say that you know that you're coming into some money in the next decade, or you're in a guaranteed increased income track or some other type of financial windfall. That might let you buy the home now, the home that you want, rather than waiting. But in many cases, you can do the same thing with a 7-year adjustable rate mortgage, commonly known as an ARM. So here's the danger. When payments get stretched out that far, people start feeling like they can afford more home than they really can. It's kind of like those 8-year car loans that we're starting to see. Sure, it makes payments fit your budget, but that car's worn out before you even pay it off. And a 50-year mortgage could encourage buyers, especially first-time home buyers, to max out. And when you own more house than you can comfortably maintain, every roof leak, AC failure, or insurance premium jump, that becomes a financial crisis. And that's something we're already seeing here in Sarasota and Manatee counties, where home insurance rates and property taxes have climbed and stressed people out over the past few years. So stretching your payment longer doesn't fix affordability, it just hides it. Okay, now let's get to the bigger picture. The problem isn't just high rates. So if rates go down, prices may actually go up, and I kind of expect that. So let's look at that 3% rates post-COVID. People bought everything in sight and they overpaid. Even if mortgage rates drop below 5% or even 3%, it wouldn't fix the Sarasota market. Why? Because most people who need to move, those aren't the ones moving. I'm talking about baby boomers and those older retirees sitting on hundreds of thousands of even millions of dollars worth of equity. And many of them want to downsize from big homes in places like Siesta Key, west of the Trail, Palmer Ranch. But they're stuck. If they sell, the IRS is going to take a massive chunk of their profit through capital gains tax. So right now, a married couple can exclude up to $500,000 in gains on their primary and $250,000 if you're single. But what is happening is that number was set decades ago when the average home price was kind of a fraction of what it is today. So say a luxury homeowner bought something for $400,000. That might be worth $1 million or $1.5 million now. And selling it could trigger hundreds of thousands in taxes. And that's after tax write-offs, things like realtor fees, closing costs, and moving expenses. So why would they sell? Most kind of choose to stay put. And when they stay put, inventory freezes, which is exactly kind of what's happening across Sarasota, Bradenton, and Venice right now. Now, here's an idea, and it didn't come from me, but I've heard it before, and it only will continue to make more sense as real estate values continue to go up year after year. If policymakers really want to unlock the market, they could simply raise the capital gains exclusion. For married couples, maybe they can go from $500,000 to $750,000, or maybe even $1 million, whatever it takes. It might be a particular number. And that one move would free up tens of thousands of homes for boomers and retirees across Florida. They'd finally be able to sell without losing 30 to 40% of their profits through taxes. And they can move into that next phase of their lives. That means more listings, more movement, and a healthier, more balanced market. Some would say that is just one more tax break for the rich, but often these boomers with these high equities that are going from big houses to a smaller house, or maybe they're going to assisted living. And trust me, they will need every penny to afford assisted living. Alternatively, maybe the government could just kind of allow sellers to roll over their home equity, just like another investment, into property without paying capital gains immediately. Maybe try this on a 2-year trial basis and see how it goes. Either change would get people moving again, and far faster than that 50-year mortgage plan I just don't believe in. So what do you think? I'd love to hear about your comments. Do you have any other proposals outside of lowering interest rates that you think would unlock the housing market? So what does this all mean if you're looking to buy in Sarasota, in places like Lakewood Ranch or maybe Welland Park? If 50-year loans ever become available, they might sound tempting, but you're only saving maybe a couple $100s a month while paying decades more in interest. And that's not financial progress, that's kind of financial drift. Instead, focus on what actually creates wealth here. Carefully buying a home in an area that you truly love, holding it through Sarasota's long-term growth cycle, and negotiating the right deal up front, not stretching the loan to make it fit. That's why understanding builder incentives, tax implications, and the local appreciation trends, it's so critical right now. We'll keep you informed every week, so make sure you subscribe and hit that notification bell. So a 50-year mortgage might look like a solution, but I really think it's just a distraction. If you truly want to unlock the Sarasota housing market, it's not simply about longer loans or lower rates. It's about freeing up the homes that current owners really want to sell, but they can't because of tax laws that kind of really no longer fit today's prices. Now, I'd love to hear what your thoughts are. Do you think 50-year mortgages could help Sarasota buyers? Do you need to fix capital gains first, maybe? Or is there another solution? I'd love to hear it. Drop a comment below, and I'm curious about what you think. And if you're planning to buy, build, or relocate anywhere here around Sarasota, whether that's Lakewood Ranch, Welland Park, Parish, reach out to me directly so we can have a conversation about your exact home buying needs, so you can buy with confidence in a neighborhood and the price that you want. We even offer our Love It or List It home buyer guarantee to make sure you're 100% happy with your purchase even years later. Call me for details. For living and buying in Sarasota, I'm Rob Rovnak. I'll see you on the next one. Bye for now.